Investing in the stock market can seem intimidating to new investors, and I was one of them. So I'm going to break down every single term you need to know so you can make money in the stock market. Starting with the basics, what is a stock? A stock represents ownership in a company. When you buy a stock, you're buying a very, very small piece of that company, known as a share. Companies issue stocks to raise money for various purposes, like expanding their business or launching new products. In return, shareholders get a claim of the company's profits. For example, when you buy shares of Apple, you own a very, very small portion of Apple. A stock exchange is a place where stocks are bought and sold. The most popular ones are the New York Stock Exchange, or NYSE, and the NASDAQ. Prices are determined based on supply and demand. If there is high demand for a company's shares, the price will increase. If the company's future growth looks doubtful, sellers of the stock can drive down its share price. Compound interest is when your money that has earned interest earns off of that return. For example, this chart shows the growth of $10,000 that compounded 5% a year. After 30 years, it's worth over $40,000. So compound interest made you $30,000. Next, we have ticker symbol. A ticker symbol is a group of letters that's assigned to a stock for trading purposes. Amazon's ticker symbol is AMZN, Apple's is AAPL, and Microsoft's is MSFT. Market capitalization, or market cap for short, is the total value of a company's shares of stock. It's calculated by multiplying the current stock price by the total number of shares. Apple's stock price is $226.34, and they have this number of shares. When you multiply these numbers, you get 3.47 trillion. So that is Apple's market cap. Small cap is a company's value between 250 million and $2 billion. Mid cap values range between 2 to 10 billion, and large caps are any value above 10 billion. Another term is dividends. This is a very popular term in the stock market because some people focus only on dividend stocks. Dividends are payments that a company makes to its shareholders. These are typically companies that are in a stable position, like Google or Johnson & Johnson. Companies that pay dividends often do so quarterly, so that will be 4 times a year. For example, if you own shares of Coke, you receive regular dividend payments for holding their stock. For every $100 of Coke stock you own, you get $3.04, or 3.04% a year, and 76 cents a quarter off of that $100. Very often, people reinvest their dividends to earn more money off the reinvested dividends. Earnings per share, or EPS for short, is a measure of a company's profitability. It shows how much profit each share of stock has earned. It's calculated by dividing the company's net income by the total number of outstanding shares. The higher a company's EPS, the more profitable it's considered to be. This is the formula for EPS. Then we have the price to earnings ratio, also called PE ratio. This is a very popular term in the stock market because it's used as a valuation metric. The PE ratio is calculated by dividing the value per share by the company's earnings per share. It helps investors determine if a stock is overvalued or undervalued compared to its peers. The PE ratio can differ in sectors though. For example, a technology company will have a higher PE ratio because investors expect more growth since it's investing in research and innovating. But if you look at the financial sector, their PE ratio is going to be much smaller because they're a more stable industry. So when using a PE ratio, it's better to compare within sectors. A lower than average PE ratio can mean a stock is undervalued since investors are expecting below average growth. Tesla often has a high PE ratio because investors expect high growth, but oftentimes this can mean that you're paying a premium for it. A bull market is a period when stock prices are rising or are expected to rise. A bear market is the opposite, so that's when stocks are falling and prices are expected to fall. As you can see on the screen, from 2009 to early 2020, we experienced a long bull market. As you can see, stock prices steadily increased. Volatility refers to the price fluctuations of a stock, or the stock market as a whole. High volatility means larger price swings, while low volatility means more stable prices. Tech stocks like Amazon and Netflix are often more volatile compared to more stable stocks like Procter & Gamble. Next, an IPO stands for Initial Public Offering. This is when a company first sells its shares to the public. For example, when Facebook, which is now called Meta, went public in 2012, it was a highly anticipated IPO. Day traders like to trade these stocks since they are often more volatile and experience larger price swings. Blue chip stocks are large and stable companies with a history of financial stability. So they've been weathering economic recessions, COVID, stuff like that. And they also have strong performance. Think of companies like Amazon and McDonald's. Growth stocks are companies expected to grow at an above average rate compared to other companies. So for example, this could be Netflix and Google. Value stocks are companies that appear to be undervalued and priced based on their fundamentals. They often have low PE ratios. Warren Buffett's Berkshire Hathaway is known for investing in value stocks. Now, index funds are mutual funds or ETFs designed to follow preset rules so that a fund can track a specified basket of investments. For example, the S&P 500 index fund is one of the most popular, which includes 500 of the largest U.S. companies. Diversification is a strategy of spreading your investments across various companies to reduce risk. A well-diversified portfolio might include stocks, bonds, real estate, and cash. Volume is the number of shares that are traded in a time period. Often, after a company reports earnings, the volume or number of shares traded is higher because investors are digesting new information. Finally, we have dollar cost averaging, or DCA for short. This is the investing strategy of investing a certain amount on a regular basis. So this could be weekly, monthly, daily, it doesn't really matter. It just has to be on a fixed time frame regardless of the share price. Dollar cost averaging can lower the average amount you spend on investments. It reinforces the practice of investing regularly to build wealth over time. It's automatic because it takes concerns about when to invest out of your hands. It removes the pitfalls of the market timing, such as buying only when prices have already risen. It can also ensure that you're already in the market and ready to buy when events send prices higher. And this is the big one, it takes emotion out of your investing and prevents you from potentially damaging your portfolio's return. Very often, people are led to invest based off of their emotions, which I've done that as well. But when you dollar cost average, you're doing it at a fixed time, so whether a stock goes up or down, you're buying at all the prices. With that said, I hope this video brought some clarity to investing. As long as you're consistent, you'll learn along the way just like I am. Thanks for watching. J Money out.